Okay, let's begin. Welcome, guys. This is an Alphachain live trading event, and we will be covering the non-farm payrolls. So the non-farm payrolls is expected at 12:30. So we've got about 25 minutes or so to cover some of the key points that you need to be aware of going into this live trading event. So I'm going to touch on to sort of all the key points. Feel free to ask questions through the chat box, guys. And I'll answer it as we progress. So let's start off with looking at the an overview of what's taken place recently. Then we're going to go into the detail of the non-farm payrolls, have a look at the some of the stats that in regards to GDP, inflation, interest rates, and recent employment job reports. And then we'll come over to the charts, getting ready for the actual occurrence, the actual sort of macro data being released at 12:30. Okay, so let's go straight into it. So some of the key points to highlight, guys, is that Asian and European shares. So the Asian session overnight and the European session this morning has been quite bullish. It's been bullish on the hopes of a vaccine. Okay, it's been bullish based on the hopes of a vaccine. But as we come nearer to the time, we're going to see markets maybe stalling slightly, holding still and waiting for the non-farm results. The non-farm payrolls takes place on the first Friday of every month. Due to the July 4th Independence weekend coming up, it's taking place on a Thursday, being the 2nd of July as we head into this new month. So the non-farm payrolls expected today, as you can clearly see. We're looking at the non-farm employment change figures at 3 million. Okay, so previously it was 2.5. We're looking at 3 million is what expected. The unemployment rate to be better than the previous, which was at 13.3%. The forecast is at 12.4%. Those two will be the ones that I'll be watching out mostly, not the average hourly earnings. That doesn't matter as much. It did matter previously, but I'll explain a little bit later. In addition to this, some other news. Tesla becomes the biggest car company by market cap. Okay, so Tesla becomes the biggest company by market cap. Let me just bring up the chart now. Let's have a quick look at what that looks like.
UK Prime Minister Boris Johnson said...
Right, so not only have we surpassed the 1,000 handle, we've broken through quite bullish, right? So we're above the 1,100 figure. So that's $1,100 per share. Okay, so it is become the biggest car company by market cap. I think the market cap has gone well over $210 billion. Moving on, let's have a quick look at NASDAQ 100. The NASDAQ 100 hits record highs, and that's largely led with tech companies. Okay, so the tech companies have been outperforming. So we're looking at the 4-hour time frame. So looking at the sort of larger picture, you can see sort of, making fresh all-time highs again. So another sort of record breaking in regards to tech firms. Tesla is a car company, but it is a technology company also in some ways. So NASDAQ has done rather well with companies such as Apple, even though we've heard that there's been more store closures in the US. I think there's up to now 77 stores being closed, but Apple shares have been over this current period doing well. In addition to that, we've also seen Netflix, Zoom, and some of these other technology companies which are being used in this current lockdown times, and has allowed the NASDAQ to hit this record high. Okay, so those are some of the sort of key points I wanted to stress. Now moving on back to the non-farm, which is expected in about 20 minutes time. Let's give you sort of an overview of what's taking place. Okay, so recent hopes over the coronavirus treatment has helped boost sentiment in the short term. We've seen positive results for a potential vaccine from BioNTech and Pfizer, and the fact that this is a vaccine rather than a treatment which could have huge consequences if proven effective. It's not proven effective as of yet. But there's also still fears that such a vaccine would take time to come to the market also. So that'll be the next hurdle. Once we have the vaccine, how long will it take to, come through in regards to the supply? Yep. Moving on, so the US unemployment report is going to be our final high impact data for this week. Okay, we know that the US markets, which are going to be closed tomorrow for this long Independence Day weekend, as mentioned, the expectations we're seeing is at 3 million. Okay, so 3 million jobs to be created in June. That's up 2.5 million from May. Okay, so those are sort of better numbers as we can see. That's not exactly a very sort of clear picture, but exclude that for now. Something to sort of bring up is this forecast. How is this forecast taken? Okay, so how is this forecast taken? It's taken based on a consensus of a number of economists, as well as other sort of institutions giving their view to what to expect. Okay, so I'm just going to sort of bring up this over here. Let me just see if I can sort of bring this through, zoom in so you can see clearly. So we can see the consensus in the middle here. So you can see the consensus in red, which is what we're expecting the number to be. Anything slightly above or below, it's fine. Okay, that's what the consensus is. That's what's going to have that positive rhetoric. Anything more than that is even better, right? So anything comes in higher is a better number, but anything below obviously is not so great. You can see sort of UBS, Barclays sort of are on the lower side. Okay, so you can see some of the institutional banks, Deutsche Bank, Rabobank, Barclays, UBS, Nomura. So all of these guys are at the tail end. And on the other side, you got RBC, NatWest, Citigroup, Morgan Stanley, Goldman's on this side of the consensus. Some of these think that the numbers could be better. Okay, I mean, it'll be great if you guys can sort of put into the chat. If you put in the chat, what is your forecast? This is something that we used to do on the trading floor. We used to put it on the whiteboard. Everyone's forecast prior to the actual data being released. Once you've done your own due diligence, you've done your own research, and that's something that you should continue to do. Is define what you think would be the most recent results. Okay, so I'll come back to this document in a minute or so. I've got a few more things to cover also. Yep. So, okay. It is worthwhile, guys. Can you please mute your microphones? It will be in the betterment for everyone else. Yep. So I'm not sure. Let me just see if I can do that. Okay, so that's done. Right. So, yeah. Okay. Cool. In regards to giving you sort of a reminder of what took place previously. So last month, the unemployment rate had unexpectedly fell to 13.3% when expectations had been for it to rise close to 20%. So initially it was thought to be a much worse case than actually came to sort of be concluded, the actual. Okay, so the forecast was far worse than the actual. Okay, so unemployment claims had risen by millions during those weeks and that period in those previous months, right? So this, caused some uncertainty to the labour market as a whole. Okay, so even though we've seen unemployment claims rise by millions each and every week, why was there sort of a turnaround in regards to the unemployment rate? Now the explanation to this is due to the classification of workers who were recorded as employed but absent. So the guys that are sort of reporting this data, there weren't a clear guidance to how to correctly fill this information in, especially of what's taking place. So there was a lot of misunderstanding in that way, and therefore the data actually wasn't so correctly filled in. So these so-called employees, but they were absent from work due to other reasons. Okay, so if these people have not returned, they will be reclassified, so adding the potential for a big downward shock also. So now we know that, okay, the dollar has been weaker and equities were higher as risk-on flows have taken place due to the hopes of a vaccine. And investors are now naturally in a more positive mood, and we've seen from that graph that I just showed you a few seconds ago, which is most of these large institutional banks are on the positive side than on the negative side, because we're expecting better numbers than the previous month. Even with that uncertainty that took place in regards to the classification numbers and the classification in the previous month. Okay, so there is good reason, to think that many employees will return to work in June, as we know that we've begun to reopen, especially in the US. The US have begun to reopen, but there are recent fears to that as well. But if we look at yesterday's the ADP figure, okay, so the ADP figure that came in yesterday. So if we go to yesterday, so looking at this ADP figure over here, so this is the high impact data from yesterday, which counts actual paychecks processed and bases its model on its own internal numbers. Okay, so it suggests that 2.3 million jobs were added last month. So despite that, the massive absolute gain, the number is still very far away and it's short of the forecast, which we're expecting at 3 million. Okay, and we could see if there's a big miss, that could dampen that positive risk-on sentiment as we approach this long weekend holiday in the US. Okay, so just be cautious to that. And if that is the case, then we could see any short-term gains that has taken place that could quickly fade as they realize that these numbers could deteriorate far quickly, especially if states are beginning to reverse those reopening policies. Okay, so especially in this recent week, we've seen the food service industry in places like Florida, California, and Texas. They're going to be taking a big hit, especially when we've got these bars and clubs, restaurants all continue to remain closed. Okay, there are going to be new restrictions will be announced. That's going to be taking place potentially today, at some point today, prior to going into sort of July the 4th, a long weekend. So that's sort of another issue to sort of be concerned about. Now, even with these clear risks of reclosing that we've seen, the market does still seem to show a positive sentiment. Okay, so as mentioned, even if we look at the Nasdaq making all-time highs, if we look at the S&P 500, what should we do? Okay, we'll bring up the SPY. So I mean, it's still overall positive. There's not too much of a negative sort of move taking place. Okay, price sort of holding above the 3,000 handle when we look at the S&P 500. The S&P 500 do see that as the broadest indicator to market health in the US. Okay, not the Dow, not the Nasdaq, because they're quite specialized. But the S&P 500 is a much better, broader market to gauge the strength in the US equity markets. Okay, so I mean, overall, the broad trend in equities has been positive. It's been positive. Okay, now that dynamic could hold true again if we start to see buyers looking to buy these dips. That's often what we're seeing now. Every time there's a little bit of negative news, we see a bit of a dip in the market, and that's a buying opportunity for those long-term holders, right? Especially those believers of the V-shaped recovery. Okay, so especially sort of V-shaped recovery sort of talks taking place currently. Now, something to remember is the fact that the true employment figures may not actually occur until the end of the month, especially when the US unemployment benefits through these stimulus packages begin to run out and the economy begins to take the true impact from the aggregate demand that we've seen. Okay, so we could see maybe a double dips sell-off taking place. Okay, so we can see sort of the first initial sell-off, a bit of a recovery, and then the next move lower as we head into the sort of end of the summer, sort of winter periods, where those vaccine hopes are removed, and we see employment figures much worse than we'd expect currently. Okay. Now, so that's something that's sort of to finalise on is the fact that
they're extending the ban on international
okay.
flights
So
out to
despite the
August 1st.
optimism that we've seen in this recent sort of bullish trend, this represents anything but a V-shaped recovery, especially if you're looking at the S&P 500, not the Nasdaq, which is almost a it is a V-shaped recovery because it's gone on to make fresh all-time highs. But the S&P 500 has still stalled, and it's starting to show a weaker trend sort of direction if you're looking at the angle of the trend direction. So it's not such a V-shaped recovery as at the moment. But also, something to look at is the long-term view. Okay, so look at the numbers prior to March. Look at the numbers prior to March. The job gain is not in line. With those numbers previously. Okay, so non-farm employment, was still 18 million short from those February numbers. Okay, so that's something to be wary about. Now, when we're looking at macroeconomic data and the jobs report falls within this, what are the other three there are three elements that is considered when central banks review these indicators to determine the interest rate levels. Okay, now we know about the employment figures. Okay, so if I'm just bringing up unemployment rate, this gives you a quick snapshot. So just looking at the one above over here, so this is sort of data overall, so United States. This is showing us the GDP year over year, but GDP quarter over quarter, we've seen a negative 5%. Interest rates at 0.25, inflation at 0.1, jobless rate, we're seeing a much higher number than previously. Okay, so 13.3%. Right, do remember the US was at record lows, reaching 3.5, 3.6 in this region here of unemployment rate. Okay, now that has drastically sort of gained. We've seen what was previously expected 20%. It wasn't as bad as that, but we've had a 14.7% sort of unemployment rate. There's been a slight drop since, and we want to see a continuation in this falling. Now that's the positive outcome, but if we see another rise, anything above 15%, that's where we got to be concerned. Okay, that's where we need to be concerned. So this is a jobs report. That's something to be wary about. I'll come back to interest rates afterwards. That's the sort of the final. But GDP, you can see GDP has fallen. How do we define a recession? Well, if you have 6 months of negative GDP. Okay, so we've got already 1 quarter of negative GDP. Another quarter as we sort of approach. We're now at the mid-year point. Okay, mid-year point in July. We're going to get the next quarter's results. Once we have sort of 2 of those, then we can class that from a macroeconomic standpoint as a recession. Okay, so yeah, that's something to be wary about. Inflation has fallen. Okay, so inflation has fallen. It's a way to define average price levels from those basket of selected goods and services in an economy in comparison to previous periods. Okay, so we've seen that fallen, and that naturally has that knock-on impact on interest rates. Okay, so interest rates, which was around the let's go with sort of 2.25%. We come into sort of the new year being at 1.75%, and then you can see March, right? In March, it goes from 1.75 with a couple of sort of emergency meetings taking place, had fallen down to 0.25, and that's where the market or central bankers have kept it, okay, at 0.25%. So, a lot to be concerned about if you look at the macroeconomic data, even though we're seeing positive rhetoric overall due to the most recent hopes of a vaccine. Okay, so the hopes of a vaccine. Okay, feel free to ask questions, guys. Feel free to ask questions, guys, at any point, and I'll just I'll cover that at the time. Not sure where it is, but okay, somewhere. Right. Now, moving on, let's look at the charts. We've got about 7 minutes before the data is being released. Now, what assets will you be trading? Okay, what assets are you going to be trading? That's the key here now, right? Most of our traders are forex traders or crypto traders. Okay, so we are solely focused on forex. Even though I went through some of the sort of key themes, especially a thematic sort of, Tesla. We've covered the Nasdaq, making those all-time highs, breaking through 10,300, we're at 10,332. We've seen the S&P 500 stall just above the 3,000 handle at 3,116. So let's look at sort of some of the assets that I'll be focusing on. Something that I'll be looking at. Now, on a daily basis, we have $6.6 trillion traded. Okay, 53% of that is in the euro dollar. So let's have a look at euro dollar. That's where you expect the moves to take place. Euro dollar's just over here. Now, let's have a sort of quick overview. Okay, so looking at the daily time frame, look at the prior sort of key levels of trend analysis. Ideally, most of our traders have already done this. You already know sort of what the key levels are to be aware of, what the current trend is. We've seen this downtrend from those highs around the 125s. Okay, so from 125 we went all the way down to sort of 106 region of the period from 2018 onwards. So that's a sort of a 2.5 year overview, two-year overview. Right. So what's taking place recently is just marking out sort of key levels of highs and lows. Okay, just looking at putting in sort of that being the most recent high. Let's apply the most recent low just in this region here. Okay, so then we sort of move down to the 4-hour time frame. Okay, so this is our market range. Okay, so the market has been ranging in this zone as soon as it reached 2nd of June. Okay, so since 2nd of June of this year, we've been in this sort of broad range. Okay, we've only had one touch to this high, right? That high being just above the 114 handle. Please note the round numbers. Pay attention to these round numbers. So 114 just above sort of in this region here. Okay, and the floor has been 111.66. Okay, 111.66, just close enough to 111.50. Okay, so that's been our floor, and it's been consolidating in this range here. And you can sort of outline, are there any further key levels that you would want to sort of define? Maybe this is a key level. Okay, so this can be seen as another sort of key level. Let me just apply. I'm just looking for something at the moment. Just let that come out. Just give it a second. Bear with me, guys. Okay, here we are. So let's take that and that. Okay, yep. So what we're seeing, sort of, markets has broken through this range over here and consolidated in this range. The extreme cases over here. Okay, so this is the extreme case. That's sort of that initial sort of push and the break through the 114 handle, which couldn't last. Okay, so just a spike through and that's it. Okay, so the most relevant level is the 113.50 50 handle. Okay, so this level here, so you saw price come to this point over here and then retracement. Okay, next time it tries to break through, falls, comes back to retest here and again over here and over here as well. Okay, so this is on much more relevant levels because we've got 1, 2, 3, 4 touches in comparison to one extreme touch over here. Okay, so 4 touches in this region over here. Now, is there a much better level to sort of consider in regards to the most recent low? So that's another thing to sort of consider, right? So is this a relevant low? But what about this region here? Okay, so ideally, I pay a lot of attention to round numbers. It's one of those things where, once I started paying attention to round numbers, my trading, it went up by like 10%, just by paying attention to round numbers at the beginning of sort of my trading career, right? So yeah, do pay attention to sort of round numbers. I'm holding sort of this 112. Let's just adjust that maybe correctly. Let's add in the coordinates. Okay, that's done. Right, okay. So now this is important because what do I want to pay attention to? Do I pay attention to, what happened here, or do I want to sort of give more weight to most recent price, right? Just like moving averages or an exponential moving average or a weighted moving average, it gives more attention to the most recent price data, and you should do the same. You should, always pay attention to not only the most recent price data, but what do you expect to happen on the right's edge, as they call it, right? So anything from sort of this point outwards, that's your right's edge. what new orders could come in, right? There could be new orders stepping in over here. There could be pending orders waiting in this region here, in this sort of zone over here that we've defined, okay? So sell orders coming through in this region here. There could be sort of buy orders in this region here. So that's what you're going to be looking for. So where are these going to be, these turning points in market price? Okay, so let's remove some of that prior analysis. Right, now we want to sort of, hone in and go into sort of most recent, sort of a lower time frame. So looking at the 1 hour time frame, sort of highlighting, are there any other further sort of key levels that I need to identify? So we've seen sort of price consolidating and often touching this zone over here, being just through the 112. You might want to even create that into what some of our traders do is, where is it? A rectangle, sort of. So highlight that into sort of your zone. Okay, so try to sort of outline what's the perfect zone there, which would be something like this. Okay, that will be my clear zone where price is often sort of reached. You might even want to take that extreme spike there, but I'm going in with these 2 touches that I've seen here, and this falls within that zone. Then we've got this most recent resistance over here, so price reaching this resistance, the 113 handle being here, so apply right at that 113 handle, so resistance here, another sort of test, break above, and then it breaks through this region over here, and most recently around that region there, so there's 113 handle there, and then we go to sort of maybe the 5-minute time frame or the 15-minute time frame. So that's your multi-time frame analysis being applied. Okay, so we're looking at euro dollar. So sort of looking at sort of the overnight movement, we've seen sort of from the floor, so from the 1st of July yesterday, from around sort of going into sort of the afternoon session, the US session beginning, hopes coming through of this vaccine leads to sort of a bullish incline in risk, and therefore less demand for the greenback, the dollar. So we've seen euro strength coming through all the way. Now the view will be is based on what the announcement will be. Okay, so just allowing the announcement to sort of take place. Let's have a quick look at sort of the economic data which is coming through. Okay, let's wait for that to come through now. Go into today. Waiting for actual. Okay, let's just wait for that to take place in a short time period that's going to be taking place. So what I will be suggesting now, guys, is that now that you understand what the data could potentially be, but also most importantly, how can you trade it? Now you're prepared. Okay, so when that data does take place, you know exactly how to sort of trade that data. Okay, so we've got data being released in less than an hour now. So now you've applied your analysis. You know sort of the fundamentals behind this, and you can sort of start to analyze and sort of trade this market based on some of these technical regions, right? So something to consider is the fact that I'll be looking for the break above, so the break above this resistance over here, going on to sort of come out of this zone, maybe retesting this zone over here, or pushing higher. You could be looking for rejection at the resistance level being around the 113 handle, and look for price to sort of come back to our floor being just around the 112 handle. Notice sort of your buffer zone over here. Something to sort of finalize on before you sort of go into the non-farm payrolls is the fact that you need to be aware of that non-farm previously has not been one of the most biggest market movers. Okay, there was go back a few years ago, it was the most anticipated data per month, but then as we started to see sort of the global jobs report being consistently better or in line with previous, there was less individuals wanting to trade it. However, as sort of with the coronavirus-led sort of economic shutdowns that we've seen recently, there should be more volume and more volatility taking place when you're trading the non-farm payrolls. Okay, so be cautious trading into the non-farm payrolls because we're expecting more volume to come through. Something else to mention is whipsaw. Okay, so something that you could see over here. Look at these candlesticks. Okay, so small sort of, you know, bullish or bearish candlesticks taking place. You've got some indecision candles there. You have not, you may not see this. Okay, when you're actually trading that data. When you're trading that data, you may not see that taking place. You may see a larger move taking place. Okay, so we might see, you know, a whipsaw such as this, and then the trend direction continues. Okay, then the trend direction sort of begins. So when that data does or is released, you know, give it a few minutes. Give it a few minutes before you actually take the position. Okay, before you take a position, it's important you wait for that result and then trade that market. Okay, so what you don't want to do is take a trade just before. You don't want to take a trade just before. Okay, assuming that this is just before, you don't want to take a trade just before. There could be volume and momentum and sort of, you know, volatility stepping in then. So be cautious to that. So, you know, pretty much taking a trade just before the news is being announced, you're asking for trouble. Okay, it's pretty much a gamble. You're better off just going to the bookies and putting on a horse. All right. Ideally, wait till the news is being announced. Once that's being announced, you know, give it a minute or so. Start to see the trend direction. See, you know, which way you want to take it, and then trade it that way. That's one option. Another option is don't trade it straight after the news. Don't trade it straight after the news. What you might want to do, let me just wait to sort of, you know, give. Okay, what you might want to do, you have the initial whipsaw taking place, and then all of a sudden it starts to calm down, and then you're looking for your trading opportunity. Okay, then you're not sort of just getting involved there and then. You're waiting for it to potentially, say, reach this handle here. Okay, it reaches around 113.50 level, and you see a little bit of rejection, you know, trying to break the lows, and then you're looking to sort of trade that. Okay, so you're sort of looking for the break lower, and then you trade that market. Okay, so you could look to fade, you look to sort of buy the dip. So these are sort of reversion to mean strategies. You can wait for the break out of this consolidation sort of range over here and look for the new trend direction if you're trading on the longer term. So there are quite a few options to be able to trade the non-farm payrolls. But remember that it's the surprise factor is what drives the market in a certain direction. Okay, it's where you start to see more volume coming to the market and a larger breakout taking place. If it comes in line, you may not see a significant reaction. So always be cautious to that. Is that it's the surprise element is what drives markets in a certain direction. Okay, and that covers the non-farm payrolls event to be taking place. It's going to be taking place quite soon. So what I'll do is, in regards to everything that I've spoke about, I do have notes. This will be sort of put into the group. Okay, so this will be put into the group, and then feel free to share your questions. And you know, we're going to be trading. We're going to be trading this event, guys. So make sure you're at your desk. You're not out on lunch. So yeah. So let's stay in touch through the online trading room. Let's trade this. And let's see what takes place, guys. So, yeah, feel free to ask questions in our forum, and I'll speak to you guys soon. Okay, bye-bye.